Hello guys, so I'm here today with a trade breakdown of a setup I took on CadJpy last week. That should be on Tuesday. I took it on my $70,000 funded next account, the one that got scaled up. The account was in about a 3.5% drawdown last time I showed it to you. So this setup assisted me to recover the drawdown, and currently it's at about 0.4% drawdown. So it's very close to my starting balance, and I'll do the trade breakdown in a minute. Also, I've been posting mostly on Fridays, but I decided to do this video today on Monday because I'm trying to introduce a series where I'll be posting every Monday as well. Or let me say whenever I can, simply because trading is very wide, and if you want to be successful, there are a lot of dynamics and perspectives you need to understand. I've done my best to share a lot of trade breakdowns, but you see, trading is more than that. So in the Monday series, I'll be combining different things. It could be a video about trading psychology or chart analysis, or doing a trade breakdown like this, and just taking a deep dive into some of the lessons that I've learned, things that I apply in my life in terms of even personal character that allow me to be disciplined in the markets and achieve overall success. That being said, let's get started with the trade breakdown. That's on Tuesday last week, 11th of February. So on the daily time frame, Tuesday is here. I've just marked it. Next thing I want us to look at is the bias of this market, or rather the bias that I am looking for as a short-term day trader. See, this market for a while, since last year, I think July, we've seen sellers trying to dominate price. However, at some point, buyers have been trying to push price higher. They almost corrected half of this bearish drop. But if you look at where price is today, we have some sort of indecision. It's not yet broken downwards. It's also not broken upwards very strongly the way I was expecting. Before I can get confidence to take my setup, I have to make sure price is at a very key level and other confluences in my strategy have been met. So you've already seen the setup was a buy position. That means my bias on this market was bullish on Tuesday. So how is my bias bullish, even though you can argue that this market has been, kind of dropping for a while, about 2 months or something? Now, as a day trader, one thing I've come to master, especially with using support resistance levels, is getting your trade at the perfect time, regardless of the overall trend or the immediate trend. So like in this market, the overall trend for the past few years has still been bullish, and it's not yet completely reversed for us to argue that this market has been having more sellers than buyers. However, even though the trend has been bullish, you can't deny the fact that the time you want to take your setup here on Tuesday, the recent about month or something, we've seen more sellers in this market. So yes, you can come and say the overall trend is bullish, and you're right, but you also can't argue the fact that the immediate place where you want to take your setup at this point in time, we've had more dominant sellers than buyers. Normally in the forex market, depending on your trading style, each one of you can be right. A swing trader might be right if he or she is trying to go short in this market, and a day trader might be right if they are trying to take a buy position on a very specific day like this, because the day trader is looking for a short-term setup, and if they are right on this day, you can see the market bought with about 158 pips. So if the day trader is looking for a 1:3, 1:4, and maybe their TP is 50, 60, 70 pips, they still got it right. However, the swing trader who's been holding this position for a month or something is still right on their bias, because for them, they've been going short and they're also in profit. So that being said, your directional bias in the market is probably the most important thing in terms of doing analysis. That's why whenever you're doing analysis, the first thing you always try to identify is the direction. If you're right on the direction, it's easier for you to have confidence taking the same types of setups. But if you're confused on the direction, you'll come here and you start selling. If it hits your stop loss, you try to buy. If it hits your stop loss, you try to sell. So you find yourself buying and selling in the same market over and over, and you don't have consistent results. And one thing I've mastered myself is the art of taking the same setups over and over and sticking to one direction. Hence, if I'm not certain on the bias of a market, however good the price action looks, I can't trade it, because that's how you find yourself confused. Today you're buying, tomorrow you're selling, and you have no consistency. So for me, my overall bias on this market has been bullish. How was I able to take a setup on Tuesday, considering from that time the market had been selling? The answer has got everything to do with daily bias. So my daily bias for Tuesday is determined by how the previous day candle closed. And if you look at the previous day candle, which was on Monday, it closed quite bullish, and closing bullish might not be enough of a reason. What gave me a lot of confidence that this market is about to go long is simple. We zoom out here, we try to look for a level of support, and you'll notice a lot of price touches here. So price had bounced off certain levels of support for a long time here. I'm going to mark about 2 levels which I'll further explain to you. So price came and traded first to level 1. And after trading to level 1, it bounced upwards. So this price came and traded first to level 1 here. Then we saw buyers coming in. After buyers tried to push price higher, on the second day it opened with a gap, so meaning it had pushed all the way to level 2. And this is the most interesting thing. It wasn't able to break the support at the second level. It went upwards, then it came back again at the same level. It tried to break on Monday, but this is because the market opened with a gap. But the most important thing is how the candle closes, not how it opens or how it runs during the day. How it closes is the most important thing. By the time the Monday candle was closing, price had traded back upwards, the support level. So by Monday, again, there was reason to believe these are levels where we might see price being pushed higher. How do I get confidence in my levels of support? As I've told you, if you've seen price reacting at that level more than thrice, especially on a higher time frame, there's a high chance it might do the same thing in future. This is not rocket science. It's something you can study in your charts. You can see the candles behaving like that. The reason why many people fail with support and resistance is because they try to apply it on lower time frames, or they try to apply it blindly without looking at other factors and confluences. For example, even if you're trading support and resistance, you still need to check the economic calendar. Is it a favorable day to trade? You still need to check the bias of that market. Are you applying support in the right direction? Because if you're trying to apply support, meaning you want to buy, and the market is in a very, very clear downtrend, then you're most likely doing the wrong thing. So this level of support, price had bounced off here. This is number 1. We come here, we have a second touch, a third touch. And what this means is whenever price comes here, there's a high chance we see it bouncing up. It comes, it bounces again. We move backwards in the past, and I want you to see these wicks from the same level. This wick touched there, bounced up. We have another wick which is here, touched the level and it bounced up. We can go further in the past to try to mark some more touches. We have another touch here, and just to leave it at that, let's count the number of touches. So this is 1. We have a second, we have a third, we have a fourth, we have a fifth. So these are about 5 times where price has been bouncing bullish whenever it comes to that level. So that being said, the reason why I was confident in the daily bias is not just because the previous day had closed bullish. That's not enough. It's also because price had just traded from 2 key levels of support. It had bounced from the first one, and it had come to this level and closed above it. Keep in mind, if these things happen on a higher time frame, they show us that that specific move has more significance. Because if I saw this thing happening on the 15-minute, I don't think I would have gotten the same level of confidence as I get when I see the candle closing bullish and above support on the daily time frame. The next thing you want to look at on the same day, which is Tuesday, is my economic calendar. So last week on Tuesday, the economic calendar was clean according to how I look at it. Whenever we have the Fed interest rate is when I avoid trading. But when we have these speeches, most of the time, they don't affect the market that badly. I'm sure you understand there's a difference between the Fed interest rate when the data is being released versus when we have these speeches. So whenever we have a speech, most of the time I can still take my setup with caution. So that being said, it was still a valid day for me to be in the market. Next thing is to go on Tuesday on the lower time frame, and that is the 15-minute where I look for my entries. Typically, I only look at the market from 6 a.m. my time because that is where I can practically look for setups. And this is something I implemented when backtesting. So from 6 a.m., the next thing I want to look at is my price action in terms of the market structure. One advantage of trading with higher time frame key levels, even if you're wrong on the overall direction, you might still be right on that specific day. That means this market might end up buying, then it sells long term. But because you were using a key level from the daily, you still got your setup somewhere here and it hit your take profit. So by the time it starts to reverse and goes downwards, you still have secured maybe your 1:2 or your 1:3 setup. That's why you see me having confidence to take trades which sometimes look as if they are opposite as compared to what the immediate direction looks like. As long as I can get my lower time frame confirmations and confluences adding up, I can take my setup from a short-term perspective. So the structure of this market by Tuesday, 6 a.m., this is what you will notice. Price had been selling for a while. You can almost see a structure of lower highs, lower lows, something like that. And then you notice this price came to this level of support, it broke it, then it traded all the way back upwards. And what happened from the 15-minute, we had a tiny break of structure because this high was violated, you can see this price traded above it. So when the high is violated, we have some mini break of structure. Again, it's not something I consider a lot from the lower time frame. My biggest confidence here is this level of support, which has been working for about 2-3 years on the daily time frame. Now by Tuesday, before I take my bullish setup, I try to look at the concept of balance versus imbalance between the buyers and the sellers. So you want to go long in this market, but this market has been buying from this week with about 130 pips. So that means I cannot take any setup until this market does a significant pullback. Now, by Tuesday again, which is this point, price had already done a pullback. And if you look at this pullback, it's about 73 pips. So it's safe to argue this bullish imbalance has already been corrected by this retracement. Now, after we see the retracement, what is usually our next anticipation? After the retracement, the concept we are looking for is higher highs, higher lows. So that means after we see the pullback, which is a higher low, we expect price to trade and break this high, forming for us a new higher high. Now by Tuesday, buyers had kicked into this market, but then we saw sellers, and by this point in time, price had not yet broken above this high. That means we can still take our setup because we are aiming for this price to push on the minimum to break this high. So any setup we find here that is bullish is a significant setup. So now I'm going to delete this and zoom into Tuesday 6 a.m. so that we see whether we can find our confirmations. The confirmations I'm looking for is very simple. I need to see price doing something like a sell, buy, and then I will be taking that as my setup. So fast forward to about 11:30, we had price trading to the same level of support. I want you to notice how price is behaving at this level. This is why I tell you understanding price action is very important. Price has come to this level now thrice on the lower time frame. 1, 2, 3. And there's something we are noticing. When it came here, this was the low. Next time it came here, it formed a higher low and it got rejected at the same level of support. The third time it comes to the same level of support, we have a rejection and it forms a third higher low. So every low is higher. 1, 2, 3. So it's almost as if buyers are forming some steps moving upwards, which tells you sellers are struggling to push price lower. That's what the price action interpretation is. And that's a great sign for us who are trying to look for a long position in this market. Now at 11:30, my first point of confidence is price has touched a level of support. And the second thing is we've seen a long rejection of sellers by the buyers, indicating to us that we have every reason to believe sellers are struggling in this market and buyers are trying to overpower them. So the next thing I noticed was my pattern which formed. We had sellers, buyers, we had these sellers, and we had these buyers. And as long as I see that, if I drag it to the right, that's what I identify as my W pattern. These are things I've drawn on the chart for many years, so I've kind of mastered them. And how I draw my patterns, I've said over and over, is quite unique. It's my own style that I've seen in the market. Some people draw very big patterns or very clear patterns, but for me, I've just mastered that price action. Whenever you see sellers, buyers, that is a W. And then the idea of the W is this middle part is the neckline, so you wait for this price to come anywhere closer here, and I'll be taking my buy position. So the candle of 12:45 was the last candle of the W, meaning the next candle opens at about 1 p.m. So by 1 p.m., since my pattern is already in place, the next thing I'm looking for is one more confirmation from the 1 hour time frame. So the next candle is opening at 1, meaning I look at how the previous 1 hour has behaved. So the previous 1 hour after the pattern closed was between 12 to 1 on 11 February. So we go to the 1 hour time frame, try to zoom in. The candle between 12 to 1 is here, and you see it was completely bullish. So after I see this candle, I have a reason to believe from the 1 hour buyers are about to push price higher. Again, if you study price action, you'll notice some things repeat themselves over and over. See here, when price came to the level of support, what happened? We saw a bullish 1 hour. After seeing the bullish 1 hour, we saw buyers kicking into this market for a while. Same thing here. Came to the support, bullish 1 hour, and we saw buyers trying to push price higher even though they didn't go that far. So when it comes here, we see the same pattern, rejection, bullish 1 hour. we expect more bulls to follow after that candle. Or rather, let me say there is a high chance the buyers are about to take control of that market. So at this point in time, I'm extremely confident in this setup. So immediately this 1 p.m. candle was opening just at its open, I took my buy position, because ideally I wait for price to come and retest this neckline. But this neckline was very, very close. You can see the distance from this neckline to where price was opening was barely 1 pip. So that means there was no need for me to wait for it to come down to 1 pip, because that's a very tiny difference. And that explains why I made 2.8% instead of 3% on this trade. So I executed exactly 1 p.m. I set my stop loss of 15 pips and my take profit of 45. And as you can notice, this trade eventually went to my direction. And that's why I was able to make close to $1,900 on this setup and recover my account out of drawdown. So if you look at this setup, I've used a couple of things to get confidence. And I'm doing this summary to assist you see what it takes to get a high probability or high quality setup. On the daily time frame, my bias was identified. So I had already confidence in this day that by the end of this day, this market will most likely have gone upwards. So since I already know by the end of today, I'm expecting a bullish move on this market, my work only remains to wait for it to come at the specific important levels in the market. When it comes there, I want to see a couple of price action confirmations, then I can take my setup. Also on the 15 minutes, as I've told you, whenever you see this long move, we expect the correction. And after seeing the correction, another reason we also still had confidence to go long is because by this time, we were expecting at least another impulse that will break above this high. And as you can see, eventually it happened. Price went and traded above that high. So since we knew price is most likely going to break that high, when we find our confirmations here, we are taking them with the anticipation that we expect some buyers to kick in this market. So that's it for my setup. Maybe one thing I can just share with you is, as much as this was a great setup, there are a few things I'm noticing with my trading, things that I want to improve on. Some of them are based on intuition, some of them are based on repetitive data I've seen in the market over and over. Maybe I just need to collect more data to figure out how to maximize my setups. A good example is when I saw this level of support on the daily time frame, it had worked for a long period of time. And the fact that price had already rejected the first level down here, I think a few days ago, which is here, then it came to this second level and rejected, and I saw this week. I was very confident if we get a buy position from this support and it works. I was confident this market was going to buy for the next even more than 1 or 2 days. That being said, had I been smart enough to capitalize on this setup, I shouldn't have just taken a 1:3. So that's something I'm trying to see how I can incorporate in my trading. And it doesn't have to be all setup. There are very specific setups, especially the whole of last year, which I noted. Those levels had worked for a very long time from the daily time frame. And I've seen this thing happening. They give me my setup. I'm confident it's going to go for a long time, but I just take my 1:3. So 1:3 is what works averagely well with my strategy. Even a 1:4 can work sometimes, but I'm trying to understand the dynamics of not treating every setup the same, or maybe having a playbook which helps me to know the specific types of setups which I can capitalize on more. There's nothing that sucks as doing 3% on a trade while you had that idea that this trade could have easily done twice or thrice that. So I don't have to target the whole move and make, I don't know, 200 pips plus, but at least on this setup I could have done, instead of a 1:3, maybe even a 1:5 or a 1:6. So that's something which I'm trying to incorporate, because a 1:6 for CadJpy with a 15 pip stop is only 90 pips. And I can't tell you how many times even last year I saw these things happening over and over. I'm only comfortable to take my 1:3 because it's profitable, but then I leave a lot of potential return on the table. So that dynamic aspect of trading is something I'm trying to incorporate in my style. Of course, it requires a lot of data to collect, and you also have to balance this, because how I look at it is simple. Even if I'm confident this trade can do a 1:10, I'd rather do it on 2 different accounts. So let's say on one of my funded accounts, I'd just take my 1:3 to secure it, but then on another account, I can let it run to a 1:6. And not on all trades, those specific ones that my data shows me they have a higher chance of performing way above the average. So on one account, if I risk, let's say 1,000, I make 3,000. On another account, you risk maybe 1,000 and you let it run for a 1:6 or 1:7, and you make double the return. And if the second account doesn't get to my 1:9 or my 1:10, maybe I could be trailing my stop, such that if the trade moves to 45, I trail my stop somewhere there. If it moves to 60, 70, I trail my stop. So even if it starts reversing, let's say at 110 or 120 pips, the worst that can happen is that it will close me out at my trailing stop of about maybe a 1:5 or a 1:6, maybe a 1:5, which is still better than just closing the trade prematurely. So otherwise, that's it for this trade breakdown. I hope you've learned something, and be sure to check out our trading community. Links in the video description if you want to trade like myself. Otherwise, I'll see you next time.